Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Mathew. This show gets you actionable insight on everything related to mutual funds so that you can make informed decisions that help you achieve the goals that you've set for yourself. Now, ordinarily, the things that you need to make that right decision is information. And when you look at various platforms, various organizations that give you that information, one of the things that you will use to determine which fund to invest in is the performance of that fund over a period of time. And invariably, I've found that investors look at just the last 12 months. But even if they look deeper and they look at the rolling returns, say over a 5-year or a 10-year period, that is not enough even there. We're talking about a few metrics that you will use beyond just the returns that you will benefit from, that will help you make the right investment decision. Those are the standard deviation as well as the beta as well as the sharpe ratio. That might sound a little technical right now, but we promise that we will break it down for you. Joining me on this program, I've got Aditya Shah, the founder of Hercules Advisors, and Rohin Pagdiwala, the CFP and founder of Pagdiwala Investments. Thank you so much, gentlemen, for taking the time. Firstly, what metrics do you focus on? Is it just these three? Is there more? How do you reach the decisions that you make when you're choosing which fund to advise your clients? Aditya, first to you.
Generally, when you choose a mutual fund, as you correctly said, you should not just be looking at the returns. You should be looking at the risk-adjusted returns. Returns is something that are visible. Risk is something that is invisible and that needs to be studied before you invest in any mutual fund per se. So for us, these three metrics are really very important, together with the quality of the fund manager and the track record of the fund manager. These are the four things that we really look closely before we start to invest in a mutual fund per se. The strategy of the mutual fund together with this is really very important that you need to really concentrate. So these four metrics together with the fund manager is the right formula for investing in any mutual fund.
Okay, so the idea is that you don't need to calculate these yourselves. That's not the objective of this particular program. The objective is that once we're done, or once these gentlemen are done explaining these concepts to you, when you speak to your advisor, or if you're a DIY investor, when you look at a fact sheet, you will be able to look at the performance and you will look at these metrics as well and drill down and narrow down the options to suit your requirements. So let's talk about the first concept, which is standard deviation. You've probably heard this in statistics class, but how does it relate to mutual funds? Rohin, I'll start with you. Why do you look at standard deviation when it comes to mutual funds?
So standard deviation is actually a very broad metrics used for a lot of data analysis. In mutual funds, you use it to just measure volatility of the fund's performance compared to a benchmark. So ideally, you'd like a fund which is more predictable in terms of return. So the lower the standard deviation, the better it is in terms of evaluating that fund's suitability for your portfolio. So yeah, standard deviation I think is one of the more basic measures that you use to measure the risk of the portfolio when looked at from a volatility perspective.
To break it down even further, and if you were to talk about a particular fund that has, say, given a 20% return over a period of time, how would you explain standard deviation?
So a standard deviation in layman's language would mean the number of times the fund has gone above or below 20%. So every year the fund return would not have been 20% if it was a 3-year return. Some years or some months the returns would have been above 20%. Some years or some months the return would have been lower than 20%. Right? So the standard deviation measures what is the upper level and the lower level of that variation per se. Higher the variation, it means the fund is going way above 20% or way below 20%. Lower the deviation means the fund is very, very close by to 20% per se. So net, we want a fund which is very close by to the returns that we are expecting. So lower the standard deviation, the better is it for a mutual fund.
But it's not enough to look at just this metric, because perhaps just looking at this one metric will throw you off. Why is that?
Yeah, so this is, like I was saying, this is a measure of risk, right? It's a measure of
volatility.
Risk and through volatility, right? There are several other ways to look at risk. And in a fund's performance evaluation, you look at not just risk, but you look at various other parameters like Aditya was alluding to earlier. You look at the AMC's process, you look at the fund manager's track record, you will look at returns, of course, which is the most common metric that most investors will look at. So there are other ratios, for example, the Sharpe ratio, which is most widely used. There is a beta that you would look at.
So let's get into that. Aditya, beta, how do you explain it? And I think to a certain extent this will govern how a fund performs vis-a-vis a benchmark, right?
Yes. So standard deviation is just an ingredient to calculate the other two measures. One of the most important measures is beta. So what is beta actually? Beta is with respect to a benchmark. So for example, for large cap mutual funds, the benchmark is a Nifty 50 index. So the volatility of Nifty 50 index over a period of time is measured, and your fund's volatility with respect to that index is then encapsulated by beta. There's a beta value of 1 for the index, and with respect to that index, how much up and down we are moving, we are calculating that by beta. So for example, if your fund has a beta of 1.2, it means that if the index moves by 10%, your fund will move by 12%. Higher the beta for a fund, it means higher the movement it will show with respect to the index movement per se, right? So that's the broad meaning of beta, that the movement of your fund with respect to a 10% movement in the index per se.
Understood.
Right?
So therefore, and I would think that you will have different pockets of mutual fund schemes that will have different readings on this, and it will be okay to have a beta of a certain range. I would think, of course, index funds would track the index exactly, and so the beta would be 1 there. But if you're talking about large caps, because the variance on the performance is not very wide, apart from 2023, you will have the beta that is not very significantly higher than 1, Rohin?
That's right.
So, but then what ranges would be okay for mid cap and small cap and the various other categories?
So, in general, the higher the beta, I mean, you want to, I mean, depends on the objective of the investor. If you want to capture, for example, momentum in a rally in stocks, then you want to go for high beta products, whether it's equity or in mutual funds. I mean, best examples would be, let's say, manufacturing funds or very thematic funds, which are currently into, let's say, into infrastructure sector or capital goods. Funds which are heavily invested in those stocks will typically have high beta because these are cyclical stocks and cyclical funds, therefore. So it depends on your investor's objective. If you want to remain close to the index, then you're better off going with diversified funds. Of course, in that category, also small caps will have a higher beta compared to mid caps, and mid caps will typically have a higher beta compared to large caps. Okay. Because the index itself it also depends on the benchmark that you've chosen. If you've chosen the Nifty, then obviously the large cap will have a close correlation with the Nifty.
Does that also work on the downside? It obviously does, right? So therefore, if you have a higher beta, you should be okay with, losing more on the downside.
Yeah. So beta works both ways. Beta can have a value higher than 1 or lower than 1 as well. It really depends on the type of fund that you are choosing. There will be a high variance on the small cap mutual fund side of it. We have seen betas ranging from 0.8% to 1.2, 1.3%, depending on the strategy that a fund manager wants to adopt. Let me take an example. Quant, during its inception years, had a very momentum type of a strategy where they wanted to chase momentum, and because of that, their beta was very, very different from all other small cap mutual funds. Their beta was 1.2, 1.3, 1.4% at a certain point in time. So it really depends on what the fund manager strategy is. Those who are chasing that strategy, they clearly knew that they are chasing momentum, and because they are chasing momentum, that is the price of risk that they will need to really pay. So you need to really concentrate on what the fund manager strategy is, and then align it with the beta per se. But for a normal retail investor, a too high beta on the entire portfolio is not something that we would really like to see.
Understood. All right. So we've discussed standard deviation, we've discussed beta. You've kind of got a sense of how these two metrics work. So when you see a fact sheet, you will be able to judge, depending on, of course, which category this mutual fund scheme is, whether or not this is going to work for you in conjunction, as these two gentlemen have pointed out, with certain other factors, including but not limited to, the returns over a period of time, that is the performance of the fund, as well as the objective and the approach of the fund itself and the fund manager. So we will talk about one more ratio at the very least. We might be able to slip in a few more. One is the Sharpe ratio. If we have time, we'll also talk about the Sortino ratio, but we have to slip into a very quick break. Do stay tuned. Welcome back. You're watching the Mutual Fund Show, and we're discussing risk metrics that will help you make the right financial decision when you're buying mutual funds or investing in mutual funds. And we have reached the point where we're going to discuss the Sharpe ratio. Aditya, I'll come to you first, and I'm pretty sure that I'm going to ask multiple questions about this because this is a little more complicated to explain, I would think, than standard deviation and beta, which we've already discussed. How does this get calculated and what does it indicate?
I think this is one of the easiest metric to explain.
Okay.
Simply put, it is the return that a mutual fund makes per unit of risk that the mutual fund is taking.
Okay.
Very simply. Risk is hamne return, how much you got, that is called the Sharpe ratio.
Okay.
You must look at this ratio rather than looking at the return side of it, because this ratio encapsulates the risk as well in your portfolio.
Okay.
Now, this higher the Sharpe ratio, the better it is. Why is it better? It is better because for every unit of risk that the mutual fund has taken, the mutual fund is able to deliver a better return than all other mutual funds per se. Let me give you an example.
Before you do that, how do you define risk in this situation?
So, in the formula, the standard deviation goes into the calculation of Sharpe ratio. So, as I said in the beginning, standard deviation is the recipe for calculating all the other metrics.
Sure.
That's why it is a very, very important metric. Per se, you don't need to worry about it, but all other ratios get calculated by the standard deviation.
Sure. So now your illustration.
Yeah. So my illustration is, if there are two funds where on one fund the return is 15% and on the other the return is 12%. However, the Sharpe ratio on the fund A with a higher return is 0.9%, and on the other one it is 1.12%. Even though fund B has given a lower return per se in absolute terms, fund B is a better fund because for every unit of risk that the fund B has taken, it has generated a higher return per se. So our eye tells us something which is very different. Quantitative factors will tell you something which is very different. So always and always look at the Sharpe ratio when you are investing. This is easily available in all the fact sheets. Higher the Sharpe ratio, the better it is, the better delivery of returns a mutual fund manager is really doing for you.
So let me try and understand this also from the perspective, Rohin, over the last year, you've had a lot of money flow into small cap and mid cap. And I've heard people express disappointment if their fund or the scheme that they have invested in either the mid cap or the small cap category has returned, say, a 35%, and the rest of their peers or maybe their neighbor's fund has done a 47%. So the gap is about 10 percentage points. But then in that situation, if the 35% returning fund has a higher Sharpe ratio than the fund that was given 47%, then I'm still better off, or that person that was saying they're disappointed is still better off? Is that how you read it?
See, in hindsight, obviously the person who's got the higher return is better off, right? I mean, fundamentally speaking, he made the money. But if you were to today look at investing, I would agree with what Aditya is saying, is that the Sharpe ratio should be one of your key decision metrics in choosing the fund, right? So in case of, let's say, people investing into small cap funds, again, and I would tie this down to what objective they came in with. If they want to ride the momentum that's in the markets and they want to capture opportunities, then maybe a Sharpe ratio, which also ideally should be measured over a longer period of time, is something that should be looked at, but may not be the primary driver of choosing the fund, right? So you want to, in this case, from a risk point of view, of course, 35% fund, which gave 35% returns, has a better Sharpe ratio and therefore is a better choice to be made in the future.
Yes.
But the fact is that the guy who already made 47% return is the one who's...
So because, and here's where we're talking about, and I think this is in a standard disclaimer on every mutual fund ad that you see as well, your past performance is no guarantee of future returns.
Yeah.
And because you're making your decisions expecting a certain performance, right?
Yes.
You cannot be guaranteed anything going forward, so you have to judge the risk that is involved in taking that decision. So essentially what we're trying to do is measure the risk and the potential return. If I'm taking less risk and getting a certain return, I should be... Is that the way to look at it, Aditya?
Yes.
So I just want to give a disclaimer to every investor today. Investors have been spoiled over the last 1.5, 2 years, where the returns have been spectacular, especially in the last 1 year on the small cap side of it. As you said, somebody's not even happy with 35% return. The perspective today is one needs to be very disciplined in their investment strategies. One needs to not blindly chase small cap funds. These metrics, if I were an advisor, I would tell them, of course, you have made a lesser absolute return per se, but the quality of those returns are really very good, and you need to stick to this fund manager per se, because when the down cycle really comes, this fund manager is going to outperform the other fund manager who has gotten the higher return per se.
The protection of the
downside, which is the risk. As I keep saying, return is something which is visible, risk is something which is invisible to average retail investor per se. So a pure play, the 35% return, the quality of the return is very, very good, and that's what the investors need to really concentrate on. The whole objective of this show is to quantify to people, at times when the markets are euphoric, don't just blindly chase returns. Try to understand about the risk that comes associated with your investments. Again, the last disclaimer I want to give, in 2017, 18, 19, there were times when small cap funds were down 30, 40, 50%. And just because we have gotten spectacular returns over the last 1.5, 2 years does not mean that they will repeat over the next 1 or 2 years. But from your end, you can be very disciplined and you can be very consistent, and you can do all these things correctly as we've told you, so that your investments are protected.
So let's look at a few illustrations as well, because that, I think, ultimately is going to help our viewers make the right choice and the right decision. I will come to you, Rohin, in just a bit, because you've got recommendations based, or you've looked at a list of schemes that you like based on these risk metrics. You've also captured some of these metrics in large cap, small cap and mid cap, right? And you've looked at flexi cap and multi cap. So I think we've got a pretty wide list. What can you tell us about the schemes that you have identified?
So the schemes that we have identified across large, mid and small cap, we've tried to look at basically the Sharpe ratio. Because Sharpe ratio encapsulates the standard deviation, Sharpe ratio also tries to encapsulate the risk that is there. And if you will see on the screen, you will find all the large, mid and the small cap recommendations as we have already given. The mid cap recommendations that you are seeing, you can already see on the PGIM fund, the Sharpe ratio is higher than 1. So basically what this means is for every unit of risk, a PGIM fund is able to deliver 1.01% of return per se. So all of these funds are really very good funds. You need to stick to these funds during times of upcycle and a down cycle. We've recommended across the large, mid and the small cap.
Why don't you talk about the ones that you've selected? Is it only on the basis of Sharpe, or have you also
I've looked at a combination of Sharpe ratio, standard deviation, even to some extent Sortino,
Sure.
Which is a sort of an evolution from Sharpe ratio. But primarily in the multi-cap or the flexi-cap category, you'll get an HDFC retirement fund, a JM Flexi Cap, a Mahindra Focused, etc. Because all of these funds have a reasonable amount of return at a lower standard deviation and a lower risk unit. One notable exception is a Quant Flexi Cap, which is high on returns, but it has got a very high standard deviation, and therefore it's excluded from that list of funds that you would invest in, especially at this point of time. Of course, if an investor comes to me and says, "Listen, I'm okay, I can stomach the risk," then by all means you can look at a high standard deviation fund as well.
Fantastic. All right. So hopefully we've cleared some doubts and we've addressed some issues that people might have in the selection. Gentlemen, thank you so much for joining in and for speaking to us on NDTV Profit. And viewers, by the way, of course, we've dealt with a few technical aspects on this particular show, but the objective was to help you make the right financial decision. If you've got specific questions on anything that we've discussed on this program, you can write to us on any one of our social media platforms. In the meanwhile, there's lots more coming up over the course of the day, and do stay tuned. This is NDTV Profit.